Good afternoon, everyone. Welcome to this session on whether to pause or not, which is about pause clauses in debt instruments. Barbados is currently the world's largest sovereign issuer of sovereign bonds with pause clauses, mainly held by private creditors. We, in a way, from the experience of having them and getting to learn about them, because we only really got them through our debt restructuring led by Sebastian Espinoza and David Nagoski. I don't know if David's in the room. So they were our advisors during our debt restructuring. We had, as a percent of GDP, the third highest debt in the world, only exceeded by Japan and Greece, two special cases, so you could argue we were the worst. And in that restructuring then, it was one of the biggest restructurings as a percent of GDP. Sebastian and David says we should put these pause clauses in our bonds, and we have no real idea what he's talking about, but it's like, why not? Of course, the creditors initially rejected them the first time round. But Sebastian kept on putting them back in, and they rejected, and Sebastian would put them back in. And by the third time, it was like, oh God, why not? So now we have these pause clauses. But we really began to think about them more after we had them, to be completely honest with you. Because climate change, our region is was one of the first regions of the world, the Caribbean, to have a regional risk pool. And we had a lot of experience of using regional risk insurance. Our region is also a region in which people experimented with cat bonds, using market-based insurance instruments. But what we found, and I think we were one of the first regions to find that, is that climate change is an uninsurable event. Insurable events are events in which you can spread the risk across time or across different events. They're uncorrelated and they are can be spread across time. Climate change is an increasing certainty of a rising loss and damage, increasingly correlated with other loss and damage. So we began having rising premiums from our insurance and falling payouts. And we began to realize that this was a problem. But in this arsenal that we had acquired by accident, courtesy of Sebastian and David, we had a really interesting instrument, the pause clause. And what the pause clause does is that when an independently determined event has taken place, a natural disaster, not a disaster that we created or we have influence over happening, a natural disaster, independently determined, interest and principal is suspended by 2 years, and then added back on with the same interest rate that the instrument began with. So these are net present value neutral. The creditor is not taking a bet on climate change. The debtor is not taking a bet on climate change. It's not an insurance instrument, but gives us liquidity in a size and immediacy that is not available in any other instrument. It, in our case, gives us 20% of GDP liquidity. We had negotiated a contingent credit instrument with the IDB, which gave us about 2% of GDP. And we thought that was good, and then we realized that we were getting 20% of liquidity. Now, this is not an insurance instrument. We pay it back, but we pay it back not an emergency interest rate, at the same interest rate as we began the instrument in. It's really about giving you breathing space when you need it most, at a scale and size. It's liquidity. It doesn't give you solvency. It's not a grant. It's liquidity. And we realize that for a world of increasing climate change, this is an important shock-absorbing instrument. And if every debt instrument had this, based around independent natural disasters, this would change the nature of the financial system. And so this became one of the key pillars of the Bridgetown Initiative in reforming international finance for an age of shocks, more profound, more frequent, deep shocks. We need more MDB lending, and the MDBs need to have more capital and lend more. We need more concessional money, but we also need a more shock-absorbing system. And we've got a great panel here today of experts, very senior and leading experts to talk about that. On my extreme left, Sebastian Espinoza, who is a partner in White Oak, our debt restructuring advisors, and the authors and the originators of pause clauses. There only are 3 countries with pause clauses, 2, and Sebastian and David designed both of them. We have Juan Pablo Bonilla from the IDB. We've worked with Juan Pablo on a number of instruments, financial innovation instruments, including our debt swap for marine conservation. And we have Ramzi Issa of UBS. In the nature of debt swaps, we may get a World Bank or IDB guarantee, but we need private sector financing. So we worked a lot with some of the investment banks, and Ramzi Issa is one of the experts in this area, looking at the sovereign clauses. And Jorge Familiar, very senior man at the World Bank, and the World Bank is a long tradition and track record of innovation in finance and treasury, and has recently announced pause clauses, and recently tinkered around with the nature of your pause clause, and including some existing debt as well as new debt. A really significant announcement given the size of the bank and its lending operations to countries who are climate vulnerable. And we have Meg Nicholson of the UK Finance, Export Finance. So when we began describing the Bridgetown Initiative, the UK looked at the international financial reforms and said, oh, these pause clauses, they make a lot of sense. And the UK became a champion of pause clauses. And this was important in spreading them, in talking about them, in reinforcing them, and spreading their influence. We have a phase 2 to go. So we've got the development banks interested. We've got export credit agencies interested. We now need to make these pause clauses acceptable with everybody and spread them widely and make sure the private sector is happy to hold them. It's not just about public sector issuing to us, but private sector happy to hold them. Private sector holds most debt that developing countries have. So Sebastian, can I kick off with you and say, if we want to spread these clauses to the entire marketplace, what are the key ingredients that we have to make sure, because there are going to be different types of pause clauses, what do you think are the 2 or 3 essential ingredients for pause clauses to deliver what we want them to deliver?
Thank you very much, Avi. I should have stressed at the start that when you asked how many countries have them, I said 2. I'm obviously referring to commercial debt instruments, Eurobonds. And of course, recently we've had the official sector announce, and they're going to be rolling it out to a host of official sector lending instruments. It may well be that other countries now have them in that particular part of the debt portfolio. But yes, you're totally right. The next frontier really is getting these things into the commercial sphere, into Eurobonds and other forms of commercial lending, such as syndicated bank loans. And I think that one of the things that we're facing is a very classic first mover problem. Not so different perhaps to the one that we all faced 20 years ago when collective action clauses were first floated, and sovereigns were very concerned about the pricing impact. Nobody wanted to be the first. And then, of course, some pressure was put, including through the US Treasury, for example, on Mexico, in fact, to take the plunge and insert collective action clauses into their debt instruments. And lo and behold, there wasn't any noticeable pricing impact. And gradually the clauses became adopted, and now, of course, they're mainstream. So I think we sort of face a similar challenge, and we just need to sort of continue to make the arguments to countries who we all feel are most likely to benefit from CRDCs. And I think also try to demystify this whole concern about pricing. I think, yes, absolutely, conceptually, there is a potential for there to be a pricing impact when a country first issues, a large...
So when you say pricing, what you mean is in terms of the yield, you may have to pay a higher yield,
yes,
as opposed to maybe a transaction cost at the beginning.
Correct. I mean, it could be structured in either way, but I think in the simplest form, there is a concern that bondholders may want to add an extra, whatever you want to call it, 50 basis points to the yield of an issuance when the country comes to market with a CRDC. I think already we do have a reference point, and Rams in his previous life, when he was at Credit Suisse, will recall that when Barbados came to issue its blue bond as part of the 2022 swap, Barbados made it very clear that it wanted a CRDC included, and no pricing impact was noted at the time. And in fact, just before the transaction was launched, the government made it clear that it also wanted a pandemic clause included in the loan. This was, as far as we're aware, the first time a pandemic clause has been used in any type of debt instrument. And again, there was no pricing impact. Now, of course, essentially these were initially privately placed transactions. They were relatively small, so we do need more reference points. But I think at the end of the day, bondholders, particularly those investing in countries that are particularly at the forefront of climate change, understand that whether they like it or not, they are taking climate risk, right? And I think the fact that there is a pre-wired circuit breaker in the debt instruments, if anything, it provides a degree of protection from a full-blown restructuring, which would probably lead to greater losses for them. So again, they're not putting themselves at greater risk. If anything, they're allowing their risk to be managed by CRDCs. So I think we just have to continue to push that.
In an orderly way. And I think, there's a thing that most people don't expect, but when a disaster happens, one of the challenges for developing countries, step back, one of the challenges of developing countries is they don't actually like to default. The perception is that they do, but they don't. They ought to default a lot more than they do. They've got a lot of unsustainable debt. Now, clearly they also need to have more sustainable financing. But the reality is that they try to avoid defaulting, and then they get into a bigger problem, and it becomes a bigger default. So if you take an example of Dominica after Maria, or Pakistan after the monsoons, they struggled hard not to default. They were afraid that if they defaulted, it would send a bad signal to the marketplace. And when you see often countries default like a year after the disaster, because they struggled and then weren't able to do it. But they're afraid to. And I think one of the beauties of these instruments is the orderly nature. It's predictable. You know what's going to happen. Now, Jorge, you've been doing a lot of work recently at the bank on thinking about pricing and thinking about how you might issue these instruments. What have been the big sort of issues and concerns for you in developing the bank's response?
Well, the first issue is we see this as a valuable instrument that complements a toolkit. We don't see it as the absolute solution for a problem which is very broad. No, disaster risk management is a key element for development. Development gains are hard won, and you can lose them overnight when a disaster hits. It's not just climate change, right? Earthquakes, all types of disasters have huge impacts on development. And part of supporting our member countries in this regard is to put in front of them a set of tools that will help them deal with incidents of different magnitudes and different frequencies or probabilities of occurrence, right? So, first of all, we see this as a valuable instrument in certain conditions and for certain clients. The second one is, as you are going to offer a new instrument, you need to evaluate what is the impact on your own financial situation and position, right? For us, our AAA is essential. It's I would say, the cornerstone of our model, and it's extremely important. And we do not restructure our debt. When a country stops paying the World Bank, it has happened throughout our history. Loans go into non-accrual, but at some point, when countries want to come back, they pay us back. That has been the story. So we do not restructure our debt. That is the basis also of our AAA rating. And we had to manage market expectations and rating agency expectations of the introduction of a new instrument, which could be understood as a type of restructuring, right? Particularly, not that much on the first introduction of this instrument, right? Because when we first adopted this instrument, it was for a particular set of client countries, those that are more, let's say, exposed to climate change for sure, and to natural disasters in general, I would say. So small states, small island states in particular. So that was relatively contained, but we only focused on new lending operations, right? It took a while and it took a little bit of dialogue to make sure that we would be fine in incorporating these clauses in existing loans. Now that we have this comfort and this reassurance from rating agencies, we're in the process of expanding these clauses. The other consideration is, well, certainly, you could have an event in which this is triggered and it has an impact on our finances, right? So what is the right price to charge for an instrument of this nature? They will have a cost, but it's a modest cost. And then, if a country needs to, we believe that there will be donors, including the new Livable Planet Fund, which might be sources of not funding, I would say, but rather concessional resources to cover the cost of these clauses.
And I see there are now 68 members of the Climate Vulnerable Forum. Are you extending these pause clauses to all 68?
We are keeping the exercise and the pilot and the observation period of 2 years as we originally envisioned it, and we will see how it works. And with the experience that we gain, we will decide where we move this.
Now, in the pause clause, Sebastian, we're able to trigger it twice in the 10 years. Is that right?
In the Barbados example, that's correct.
Yeah. So it's not that you're at risk of every event. I mean, in fact, was it 2 years ago, we had maybe a choice of triggering it and decided not to.
It was borderline. So I think that the event didn't qualify under the CRIV criteria. But yes, but the key element, and I think that's one of the differences between the Grenada example and the Barbados model, is that there is that discretion. Because especially if you're using parametric insurance as a trigger, there could be an instance where the model says it is triggerable, but the government may feel that actually we don't necessarily need the casualty relief right now. We prefer to save it for another time. So there is that option. And another change in the Barbados model is that bondholders, if they substantially object to the use of the clause, can actually block it. If 50% of bondholders instruct the trustee to block it, they can. And that came out of really of a negotiating dynamic with bondholders, as you quite rightly said, it was a restructuring, but it's put in as a safeguard in the event that a government in the future should want to abuse the clause, which personally we think is conceptual but highly, highly unlikely in practice, but it's there in any case.
So that threshold is 50%?
50%.
Okay. Juan Pablo, before there was a pause clause, there was the contingent credit facility. IDB very much led on some of these, pioneered on some of these. Do you see this as an evolution of instruments, additional instruments? Is it partly a response to changing circumstances with the nature of climate risk? How do you think about these new instruments?
Thank you, Avinash. And first of all, it's a pleasure being here about this topic. And I'm glad you asked about the contingency line, because we started, going back to what Jorge was saying, this is a pool of instruments that complement each other. So we started with the disaster risk management at the bank, doing risk assessment, and we developed the IGOP. It's an indicator of all the fiscal and institutional issues that a country has to address to have better response to national disasters. And after that, we realized the importance of having the contingency lines for the ministers of finance to have the parametric line to respond faster to a disaster. So the evolution of the contingency line, we have about 17, 18 countries of the region right now with the contingency lines for about $3.9 billion. And then in 2021, as you know, we started piloting the clauses, the CRDCs. But we said we need the country to first have the contingency line to be complemented by the clause. So it was a prerequisite to have the contingency line. And you saw the evolution. Barbados was one of the first countries to use the clause. Now, after 2021, we have 4 countries. We have Barbados, Bahamas, Honduras, and Ecuador. And it had expanded from not only hurricanes, but also to strong rain, floods, and earthquakes. For example, Ecuador expanded the clause for earthquakes and flooding. So far, due to the use of the clauses, right now we have about 1.2 billion operations of the bank protected with the clause. And your question about what is next is very important. It's the evolution of the instrument. It's complementing the contingency lines with the clauses and maybe have an enhanced clauses for the future to also have a transfer of risk to the market. A multidisciplinary team at the bank is already seeing that to see CAD swaps. So I think that is the next step for the future.
Thank you. Meg, the UK has very much been a champion of these instruments. The UK Export Finance led on developing a version of these instruments. Do you want to tell us a little bit about why the UK wanted to do that, and tell us a little bit about the instrument you have?
Sure. Yes. No. Is this working?
It is. Maybe you should be a bit closer.
Is this working?
Yeah.
Okay, great. Yeah, so thanks very much also for having me on this panel. Really pleased to be here representing UK Export Finance, being the first export credit agency in the world to introduce climate resilient debt clauses is something we're really proud of, that we were able to announce last year at COP27, because as the UK's export credit agency, we are committed to ending our net impact on climate change. So we have, in the mitigation space, been very active. We set a net zero by 2050 decarbonisation goal, but as is so evident, climate change is already happening, and we very much want to be part of the resilience response in addition to the mitigation side. And that's something that aligns very much with the government's wider policy, as well as our commercial goals and the projects that we're pursuing in the clean growth and climate adaptation space. So UKEF is the UK government's only vehicle for sovereign lending. So we're also very, very conscious of mounting debt vulnerabilities in the markets that we work in, which have been, frankly, exacerbated by the COVID crisis, Russia's invasion of Ukraine, and the widespread interest hikes that have come with that environment. So it's important to kind of recognize that debt vulnerabilities and climate vulnerabilities can intersect as structural drags on a country's fiscal capacity and development. And we wanted to make sure that for our partner borrower countries, debt payments to UKEF don't interfere with their ability to mount effective policy and fiscal responses to these shocks that are becoming more frequent as a result of climate change. So that's why that was the genesis, the kind of policy push behind our announcement. We have been offering climate resilient debt clauses as standard in all of our eligible direct lending to low-income countries and to small island developing states. We are very pleased that Guyana and Senegal have now announced that they are keen to look at including these clauses in their existing transactions with us. And we have, of course, transactions in the pipeline, which I can't name so freely, but we are seeing that there is demand for this. But I think it is important to recognize there is a choice here. I don't think it's automatically the choice that all partner countries should make. It requires careful thought. It requires careful and expensive legal advice. And we have made a small contribution towards that by covering the cost of that legal advice in any of our restructured transactions. So, we're trying to sculpt our implementation of these clauses around an outcome that will get them utilized the most and most effectively for borrowers.
Ramsey, how do you think banks are thinking? how do you think banks are thinking about these instruments? With the ability for a pause, is this a liquidity risk for banks? Are you thinking that you're going to be perhaps placing these instruments in the hands of people who liquidity is less important because they're long-term holders? How do you think about them yourself as a potential holder? How do you think about them in terms of the financial marketplace of who might be good holders of them? Do you think is it possible to strip out the pause clause element and sell it to someone else? So how do you think the marketplace is responding to these new instruments?
Okay. So thank you, first of all, for Barbados to invite me to the panel. And just one thing before answering the question, just because you mentioned at the beginning that it took Sebastian 3 times to introduce the first pause clause in the restructure. In our case, it was just the first time. So we just wanted to mention that. And it kind of leads to the second point. I think like in financial markets and in banks, the key thing is about it's to take away uncertainty in terms of the event, but also the interpretation of the event. So in the context of the question, like the way that we think about it is, especially for the longer term debt and the transaction that we did last year, the natural kind of investors for that are those that are a bit more patient. And just like issuers, investors don't also want to have a default in a restructure. So I think from the kind of the marketplace in general, it was well received because it kind of avoided the uncertainty of what could happen in a crisis to ensure kind of all actors, all of the holders were acting kind of uniformly on, assuming that there was kind of no abuse of the clause. But I think it's all about kind of taking away the uncertainty. So I think it's a very good innovation. It was very well received from investors generally in the transaction. We didn't see any pricing kind of notification impact, and there was at least on one circumstance where we did synthetically strip out for one of the investors the effect of the pause clause by repackaging the bond into a separate transaction.
Do you think there is a marketplace for, say, life insurers who are always looking to try and increase the maturity of their assets, given the maturity of their liabilities?
Yes, absolutely. So in the context of undertaking kind of the risk of or stripping out the pause clause, is that the that's a very and then them holding it. Yes. So in this particular case, it was actually an insurance company that we were stripping out kind of liquidity event.
A casualty insurer or a life insurer?
Life insurer, yes. So they wanted kind of some of the regulations in Europe require predictable cash flows. So what we did was we repackaged the instrument with a swap where if the pause clause was triggered, one of the pause clauses that was triggered, we would pre-fund into the transaction so that the investor was getting the predictable cash flow on schedule, and then once the repayment started in the underlying instrument, then that would be used to repay the loan that we provided in the deal.
Can I actually drill down a bit on that? Because one of the themes of this COP so far, with loss and damage having been taken out early on, is I've noticed an interesting theme developing, which is our regulatory system, a banking regulation, accounting regulation, are they conducive to the investment flows that we want to see? Everyone says we've got trillions of dollars of investment needs to happen, but does the regulation structure actually get in the way of some of that? Do you think regulation might be an issue for these pause clauses, for holders of the pause clauses?
Yeah. So the example that I just described in in the UK, for example, insurers have a matching matching regulation, so that in order for the investment to fit with a certain type of regulatory categorization, they need to have the payments occur on the scheduled date. So which is why we did this synthetic repackaging, so that we're effectively taking on the pause clause risk, but funding it so that the investor was able to kind of put the investment within the categorization that they needed.
So are you recommending that we work with UK Export Finance to go to the regulator, the UK, the FSA, and to discuss whether this regulation makes sense in the context it is?
It's supposed to change. So it's not because of this, but it is changing. So in the case of the UK, by this time next year, it should not be an issue, which should mean that the kind of transaction that we did would be more appealing to a broader set of investors in the UK.
Now, one of the things, Jorge, we've been thinking about, one of the advantages of this instrument is this issue of certainty. When a major disaster happens, and Pakistan's a very good example, major disaster, the holders of debt will be uncertain about whether the country will default or not. But what about on the bank side? And you talked a bit about this on the multilateral development bank side. Was there unease about the implicit preferred creditor status and accepting instruments that have these pause clauses in them?
Well, it clearly was a consideration, and again, we publicly state, and for 70 years as an issuer, we have followed this. We do not restructure our loans, right? So it was very important to make sure that this was not considered by anyone as a debt restructuring, because we would be moving away from a stated policy that we have been following consistently. Now, again, as I mentioned, I think that debate is behind us. Your reference to Pakistan is a large country. It's a different story. It's a different type of exposure for the bank. For a country like that, we make available a series of mechanisms that they can incorporate in their own national disaster risk management safety net from a financial point of view, which go from the loans with drawdown options that can be used when a catastrophe materializes, to a new mechanism that we are incorporating in each and every one of the loans that we give, which is the possibility to redirect use of proceeds of loans that we give to take care of natural disasters. This is something that we did in practice, but it was not embedded in the loans. Now, by embedding it in the loans, we will increase, let's say, the sources of liquidity that a country can draw into in case of need. Two, catastrophe bonds. I mean, as a catastrophe bonds and catastrophe swaps. No, as a multilateral development bank, I think that we are the only one that has gone into the space of catastrophe bonds. Let's say since 2009, we have issued around $3 billion of catastrophe bonds. This year, we issued one for Chile, which is the largest single country transaction of this type. This is for earthquake.
Yes. It's our view that catastrophe bonds for climate risks are going to have declining investor appetite because of the nature of that risk, because it's an increasing certainty risk. But for earthquake risk or risks that aren't increasing, then clearly they make a lot of sense. Have you been thinking, Sebastian, about credit rating agencies? How are they? Have you spoken to them? How are they thinking about these instruments? What do we do? Do these instruments need to reform or be revised in some way to make agencies more comfortable with them, or private creditors more comfortable with them?
Yes, the UK, during its G7 presidency, did create a private sector working group, which was charged to come up with a template for the market to use for the inclusion of CRDCs and bonds, and I was part of that working group. And part of the process involved consulting with the rating agencies. And it took them a little while to really understand the concept and get themselves comfortable that, you know, they weren't being asked to sort of sanction a credit event as such. I'm not sure Jorge would have had these discussions with them as well. And, you know, in a way, because of the increasing regulation of rating agencies, they become increasingly conservative.
Was there a debate about whether that was a credit event?
Initially, but and not all three agencies necessarily behaved in the same way. But I think eventually they came up, and funnily enough, one of them had a deeply philosophical internal debate as to whether they could rate CRDC instruments in the first place, because they potentially not fixed income, right? You're moving away from the concept of fixed income because the payments could move around. I thought it's a little bit silly, but anyway, they kind of went down that rabbit hole. But eventually they came back and agreed that they could rate them, and that there had to be certain criteria for them to feel comfortable with them. For example, clear triggers, you know, limited use, so not necessarily changing the profile of the debt entirely, but just creating limited breathing spaces. And finally, PV neutrality, which was important for them. So I think in due course, I think most of them came out and said, we actually think at worst, these could have a neutral rating impact, and at best, they may actually even help the rating potentially if enough of the debt has this and provides buffers for the broader, well, for the public finances and the broader economy.
Very good.
Juan Pablo, for many people, for many countries, developing countries, the international financial system is pro-cyclical. When they get into trouble, money leaves, interest rates go up, their capacity to borrow when they perhaps need it most goes down. If all private creditors had these clauses in the instruments they held, would that make the financial system more stable? Does that stability help you as a long-term development bank lender?
I think yes, but as he was mentioning, I think it's beyond private sector. As you mentioned, the role of the rating agency is going to be very important, because we're starting to see from the IDB perspective, when you have the climate risk disclosure, the TCFD is very applied to private sector banks. BidInvest is already part of that. But from the public side, linked to your question, how you are going to start working with not only rating agencies but insurance to stop punishing vulnerability and rewarding resiliency. So the question is, if a country has the contingency line, the clauses, in addition to that, you include private sector, as you mentioned, how the rating agencies are going to reward a country or a multilateral development bank that is doing that instead of punishing it. If as a public development bank, we start putting our climate risk, could be perverse. The rating agencies can say, listen, you have too much concentration on the Caribbean and Central American countries from climate risk perspective. So you need to lend less to them. So it will be counterproductive. Going back to, I mean, it's beyond what you were mentioning about private sector. It will be definite. But I think the whole discussion with rating agencies, with insurance companies, that you have been a champion on this, is going to really be needed for a real international change of the financial system.
And if there are more SDRs in that system, that could add pause clauses.
Exactly.
SDRs could be changing the character of the international system. Meg, what do you think about, so London is a global financial center. What do you think might be the challenges from your experience and perspective of these instruments, of spreading them to the private sector, for London investors, holding them as routine?
Sure. I mean, I think from the export credit point of view, one particular challenge that we are working through is how we deal in our guarantee business with private sector lenders who choose to implement these clauses. UKEF, our policy applies to our direct lending, so we have about 10 billion, modest amount of direct lending. But really, as with most export credit agencies, the vast majority of our business is in guarantees. So that is something that we're still working through in the Paris Club and through the private sector working group, in how the relation between kind of direct and guaranteed debt plays out. But we do hope that we'll be able to move in that space before too long.
Okay, you mentioned that this was part of the toolbox. What are the other things that should be in that toolbox for giving countries pause and space in crisis? What are the other instruments that you're thinking about? Although the bank is a prescribed holder of SDRs, are you developing new instruments? Not yet ready yet, but things that we should be thinking about for the future, new instruments in that toolbox? Or is the toolbox got a lot of things and we just need to be using them more?
Well, the toolbox is becoming quite comprehensive with the new additions, right? I mean, the latest additions are these provisions in our loans to redirect proceeds for disasters. I think that this is an important one, which will create lots of efficiency in rechanneling of resources, which again, it's something that we have been doing, but everyone scrambles, no? I mean, you mentioned Irma and Maria. In fact, you and I met, in precisely in the aftermath of that. What was the first step? Well, the first step is to send a team to the countries and help them with the damage and needs assessment. And the second one is, let's look at the portfolio and see what we can deploy to support. Our toolbox is quite comprehensive, and it also depends on where the country falls into, right? If it's an IDA country, well, we have, and it's a country with high levels of debt. We have, to a certain extent, embedded in the financial model debt restructuring, because IDA gives grants to countries in a situation of debt distress, right? So what would happen is, if you have a credit-worthy country from an IDA perspective, and a natural disaster puts the country in an unsustainable debt situation, they would immediately qualify for grants, right? So if we are thinking about some types of countries, we have that mechanism. IDA also has a crisis response window. In the case of IBRD, we have, again, contingent lines of credit for disasters, and contingent lines of credit in general, and all the way up to catastrophe bonds.
The IDA crisis window is a very clever, good instrument that I think people are not very familiar with. Indeed, we think of the Loss and Damage Fund, I'm one of the climate negotiators, as being a sort of IDA crisis window for non-IDA countries. So if I could put you on the spot a little bit, so is the World Bank going to be the new secretariat for the Loss and Damage Fund? Is your board going to be comfortable with the conditions of being the secretariat?
Well, not the secretariat. We're going to be the trustees, not the secretariat, right? I mean, we will, like we do with many of the very large trust funds that exist, we will provide trustee services. We will manage the assets. No, it's an asset management transaction. But these trust funds have their own governance, right? And we give support to that governance, but it's part of, let's say, an independent management by member countries of the fund. So that is the idea. And then on the on the instruments, I forgot a very important one, right? The Caribbean and Central American Risk Insurance Facility, which is normally the very first, let's say, line of defense. It's not enormous amounts, but it's amounts that are very useful to first respond to natural disasters.
Ramsey, let me give you the final word. What you look at the marketplace, what else should be in the toolbox? What is their appetite for in the marketplace for new instruments?
I think potentially even an expansion of some of the acts of God's events in pause clauses as well. I think, again, like I said earlier, which is investors also don't like to have defaults. So I think, that especially now with all this kind of awareness of climate events, I think, there is the mindset is changing to say that, having flexibility is a good thing. for investors and also ultimately for the issuers and for countries, because defaults, nobody really benefits from a default. And then I think also just generally, some of the other instruments we're talking about, the insurance, like savings accounts as well, so that you have kind of additional liquidity on tap. So I think like all those things can be part of the toolbox.
So I'm going to put a pause on my attempt to finish the session by asking Sebastian the final question, which is, natural disaster clauses don't happen across the world at the same time. And so if you had private creditors who are emerging market investors and they hold a lot of emerging market bonds, and there's a bad hurricane season in the Caribbean, they've got other investments in other places. Is a pandemic clause fundamentally different, though? Because pandemics could be global. And then if you're investors in global instruments, you don't have diversification. So do you see pandemics as being different? And if they're different, do you see bonds having a choice, that maybe some with just natural disasters, some with natural disasters and pandemics? How do you see that evolving?
Yes, I think essentially they're different animals, right? And I think it's highly unlikely that the triggering of a CRDC could lead to systemic risk. I mean, in principle, it could happen if you have a particularly bad hurricane season, as you say, but it's highly unlikely. Whereas obviously very different with a pandemic, because it could actually affect not just the whole region, but many regions, and obviously cause problems for major lenders, liquidity problems. And I know that the IMF has some concerns about systemic risk, which we fully understand. So I think the use has to be measured. It probably is better suited to countries, to sovereigns, where their economy would suffer disproportionately in the event of a pandemic. And I think Barbados is precisely one of those countries because it's so reliant on tourism and travel for that. And of course, as soon as the pandemic hit, as we learned a few years ago, the first thing that goes is travel. So I think it's got to be used carefully and in the right circumstance.
Great. So please join me in thanking this excellent panel for this really interesting conversation. Thank you.
Thank you.
Thank you, sir.
Thank you. No, qué gusto verte, súper interesante.